Welcome back to Factful Finance. Have you ever wondered how companies make big financial decisions? I'm not talking about a small purchase here and there. I mean the critical moves that shape their future, drive growth, or even avoid a financial disaster. Let's dive into this world where billions are at stake and where decisions are carefully crafted using deep economic principles. Understanding how companies manage capital and make financial decisions is a cornerstone of financial economics. So today, we're going to break it down. Whether it's deciding to take on new debt, issuing stock, or choosing where to allocate resources, companies are constantly balancing risk, reward, and long-term strategic goals. But first, let's take a look at a shocking statistic. Did you know that nearly 50% of companies fail to meet their financial goals due to poor capital management? Imagine running a business for years only to make crucial missteps in the way you allocate your resources. Let's make sure that doesn't happen to you. When companies make financial decisions, they base those choices on a series of principles rooted in financial economics. Things like risk management, capital structure, and market conditions. These principles aren't just theoretical, they're used every day in boardrooms across the world. And to truly understand how these decisions unfold, it's essential to look at both the internal and external factors that shape them. First off, capital structure is the backbone of any company's financial strategy. In simple terms, it's the mix of debt and equity that a company uses to fund its operations. Companies like Tesla, for example, took bold moves early on, using a mix of debt and equity to fuel their growth. This balance between debt and equity plays a massive role in determining the company's risk profile and financial stability. But here's where it gets interesting. The decision between debt or equity isn't just about funding, it's also about control. When a company issues more stock, it dilutes the ownership of its existing shareholders. On the other hand, borrowing more through debt doesn't impact ownership, but does bring the weight of interest payments and potential financial risk if things go south. Take the case of a fictional company, Solara Tech. Let's say they want to launch a new product, but need $10 million to make it happen. They could issue $10 million in new shares to raise the money, but that would mean giving up a chunk of ownership to new investors. Alternatively, they could take on a loan, but that means paying interest and increasing their financial leverage. This is where financial economics comes into play, making decisions that weigh risk, cost, and future returns. Risk management is a key part of these decisions. Take the 2008 financial crisis as an example. Many companies found themselves over-leveraged, with too much debt and not enough cash flow to cover it. It was a stark reminder of the importance of maintaining a healthy capital structure, where the cost of debt doesn't outstrip the company's ability to generate returns. In fact, according to a study by the National Bureau of Economic Research, companies that maintain a strong balance between debt and equity have better long-term growth prospects. So, how do companies decide? It's not just about crunching numbers. A lot of it comes down to market conditions and external factors. During times of economic uncertainty, for instance, companies might be less inclined to take on debt, fearing they won't be able to pay it back. On the flip side, when interest rates are low, borrowing can become more attractive. Let's talk about the decision-making process in action. Imagine you're a CEO, let's call you Marcus, and your company, New Horizons, is eyeing an expansion. You have two options: borrow money or sell more stock. Borrowing could be appealing because the interest rates are at historic lows, but taking on too much debt could raise concerns with your investors. Issuing stock would raise the money you need without the debt, but it also means you'll own less of the company. Marcus doesn't make these decisions alone. He'll work with his CFO, legal team, and board of directors. They'll consider everything from the company's cash flow projections to the broader economic climate. It's a delicate balance between risk and reward. Let's not forget about the broader implications of these decisions. Capital management isn't just a tactical concern, it's a strategic one. How a company manages its capital can determine whether it thrives or fails. Effective capital management allows companies to weather tough times, seize opportunities, and invest in future growth. And speaking of growth, Did you know that companies like Apple and Amazon have mastered the art of capital management? They use a combination of debt and equity to fund innovation and expansion while managing risk. By striking the right balance, they've been able to scale rapidly without sacrificing long-term financial health. So how can you apply these principles to your own financial decisions? Whether you're an investor looking at companies or an entrepreneur considering how to fund your business, these lessons are valuable. Take the time to analyze your financial structure, understand the risks, and always be mindful of the broader economic environment. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Which financial decision-making strategy do you think will be most useful for you? Drop your thoughts below. I'd love to hear how you're navigating your own financial decisions. And if you want to dive even deeper into the world of financial economics, make sure to hit that like button and subscribe so you don't miss what's coming next. If you found this breakdown helpful, you'll definitely want to check out our next video on how market conditions shape corporate strategies. Click to watch now.